Your advisor might be optimizing your portfolio for your taxes, but are they optimizing it for you? Your lifestyle, your goals, everything in between. Episode 16, Uncharted Wealth. Is your financial advisor managing your portfolio correctly? Well, if they're not, what are you waiting for? Hello and welcome to SWBC's Uncharted Wealth podcast, where we help you navigate the financial landscape to and through retirement with confidence and clarity. I am Mike Walters. I'm a certified financial planner and a wealth advisor here at SWBC. And today we're going to be diving into a common mistake that even well-meaning advisors make sometimes, okay? And it's about building portfolios that look great on paper, but fall apart in real life. We'll explore how tax strategies, asset allocation, and withdrawal sequencing can either support or sabotage your retirement. Now, one of the first things that I find to be detrimental to a lot of retirement plans that advisors are doing in your investment portfolios is trapping your taxes. And here we go again, Mike's talking about taxes, right? But this tax trap can be pretty bad long-term, okay? And what I'm talking about is advisors are prioritizing tax efficiency through asset location strategies, which is a good thing. But in this example, I'm talking about they're putting bonds in IRAs, stocks in taxable accounts, Roths filled with low growth assets. This can lead to poor liquidity and forced selling during market downturns, right? So why, you're thinking like, oh, well, these particular things, they don't sound bad, but let's break it down a little bit, okay? Why would you not want low growth assets in your Roth? Well, if you think about it, when you are going to pull money out in retirement, there's usually a sequence of withdrawal that you want to do this in order to get the best tax efficiency possible, okay? Now, there's a lot of different things that happen once you start pulling income in retirement, especially from your retirement accounts. If you're pulling from your pre-tax accounts like a 401k or an IRA, this is all coming out to you as ordinary income, just like you were receiving a paycheck. Now, if you add that on top of any pensions that you have, Social Security you're receiving, or if you're still working and still getting a paycheck, this is all going to add up. And when you're looking to pull out of your investment portfolio to either meet your lifestyle expenses or, maybe pay a bill off or something, whatever you need it for in retirement, you want to do that in the most tax efficient way possible. So advisors out there are looking ahead to try and make things more tax efficient, but when it comes to actually choosing what investments go in your portfolio, the Roth is the tax-free bucket. That's where your assets have the longest runway to grow because you ideally want to pull that money last. So in essence, you should have the longest time horizon for anything that's in your Roth IRAs, okay? And so because that's going to be the last thing you potentially touch, you can afford to take a little bit more risk. Now, again, this is not financial advice. I'm not giving anybody direct, specific, hey, go buy this in your Roth. I'm giving general advice that if your Roth IRA is going to be the last money that you touch in retirement, you can afford to take more risk to allow the ups and downs in the market to recover before you pull that money out, okay? What else did I say? Stocks in taxable accounts. That's what most people do normally anyways, but it gives you the option to do tax loss harvesting over time. What that means is, let's say hypothetically that you are buying Apple stock. Okay, I'm not picking on Apple, that's the first thing that came to my mind. And you bought Apple stock back in the 80s or 90s, and you've held it this long. You're probably doing pretty well for yourself, just saying. But for people that just love Apple stock, let's say that they've been buying it, periodically over time. They're doing something called dollar cost averaging. Well, not every single lot that they purchased, so let's say they're buying it once a month, not every time they purchase it on a monthly basis, those returns are going to be different because of all the different timings that you bought it. There may be certain lots that are down, okay? So what tax loss harvesting is you are purposefully selling those lots that are at a loss so that you can realize those losses for the current tax year, okay? With those losses, you can either use that against any capital gains that you have, or if you get to the end of the year and you have a net loss, you can write up to a certain amount of those losses off against your ordinary income. Right now in 2025, that amount is $3,000. It's not a huge deal, but over time, that can mean some pretty good savings. So this is just another example of tax efficiency in your portfolios. Now, with the way advisors are trying to limit the amount of exposure to certain types of investments in these particular accounts, there's been some studies out there saying that this can save anywhere between 0.1 to 0.3% in tax savings annually. That may pale in comparison to having to sell in a down market. So if you have the wrong types of investments in the wrong type of accounts, like for example, your low growth stuff in your Roth, or let's say you have something super conservative in your taxable account and you need to go and sell it for income, like in the current year, but it's at a loss, right? You're not allowing yourself to kind of weigh the options of, okay, well, maybe I sell it out of the Roth, maybe I sell it out of my pre-tax account. Just having that flexibility is power in and of itself. And because if you have to go and sell something at a loss and you're not ready for it, you may not ever make up what you lost on that, right? So people think back to 2008, 2009. They think back to those few months during COVID where everything kind of just went, that was probably a bad sound effect, but that's just what was going on in my mind. Or even 2022, the whole year was bad. But we're trying to avoid having to sell at a loss, right? So maybe just even diversifying the types of investments in the different accounts can help you in the long term. So a great analogy, I didn't come up with this, I had AI help me with this, but it's like packing your suitcase for a vacation based on weight, not the weather. So like, oh, I'm gonna keep this luggage under a certain amount because so-and-so is not gonna charge me any baggage fees if I keep it under 10 pounds per se. But you're not packing for the weather. It's like, sure, it's efficient, but are you actually prepared for your destination? That's similar to managing your investments correctly, okay? Now, the second thing that advisors are missing on is the real life risk, which is sequence of returns, okay? So if your taxable account is all stocks and the market drops and you need some of that money to live off of, well, you have to sell something at a loss. And we just talked about it could take you so much longer to make that up. And in retirement, you don't have that long time horizon that you did while you were still in your accumulation years. So that may not be something that you're willing to do. This will undermine your overall withdrawal strategy and the long-term growth of making sure that you don't run out of money, because that is never an option, okay? And once you start retirement, right, so let's say you were to officially punch out in 2025 for the last time, and all of a sudden we go into a market downturn, well, that could mess up your whole retirement just if you had a 1, 2, 3 year downturn because you weren't prepared from that, okay? So if you're withdrawing from assets that are volatile like stock, like tech stocks and stuff like that, this could really derail your whole retirement. And you just started. It's like you just started your retirement and now you're having to look back and things are not looking good for you. So imagine needing like $40,000 from your account and you're down 25%. So you're not just withdrawing $40,000, you're locking in that 25% loss. How long do you think it might take you to get that 25% back? Okay, so just think about it in those terms. It could take you a long time to make that back up. All right, well, I'm going to stop this episode here just for a brief moment to say that if you have not subscribed to this podcast, I am going to stare at the camera awkwardly until you do so. Just kidding, but I really did hope you went and subscribed, okay? Make sure you engage with us in these videos. Sometimes it feels like I'm talking to myself, which I kind of am because it's just me talking, but this is the selfless plug for you to go follow, like, and subscribe to the SWBC Uncharted Wealth podcast. Now, moving on to the next segment. This is what we do differently here at SWBC, okay? We do it a little differently, okay? So our approach is to balance the tax strategy with real-life flexibility, okay? We use stable assets in the taxable accounts, like your individual, your joint, your trust accounts. These are what we call taxable accounts, to support your early retirement withdrawals. That way we're not pulling from something that is your long-term oriented growth bucket to support your lifestyle, because again, we don't want to pull if we don't want to be pulling from there if the market takes a downturn. Then, like I said at the beginning, your Roth accounts are going to be prioritized for the long-term growth. Okay, so this is where you're going to want to have your aggressive stocks and oh my God, my brother just told me about this stock and I think you should go all in on it. Cool. If you subscribe to Wall Street Bets or something like that, you want to do this in your Roth, okay? Because this has the longest time horizon. Again, you want to let this money grow as long as possible because, again, this is your tax-free bucket. With that, we are planning for market volatility. There's some unknowns when it comes to retirement, and market volatility is one of those unknowns. But I will say we do know that at times the market's going to be way up, and we know at times the market's going to be way down. I can tell you that with complete certainty. It's either going to be way up or way down at certain times. So we need to plan for the eventual certainty that it will go down. Okay, so that's why this is so important. We are planning for the market volatility, not just these market averages that people go on and talk about. You know, when they're building their portfolio, oh, the stock market averages X amount per year, or the bond market averages Y per year. We don't want to do that, okay? We want to have a significant and detailed process for when we start drawing income in retirement to make sure that we are going to weather whatever storm is coming our way. And our goal here is not just to save you taxes, it's to help you sleep at night, to spend carefully, and stay on course through all these different market cycles, because again, we know that it's going to go up, we know it's going to go down. Personally, I don't like roller coasters, but if you do, that's not something you want to do with your retirement portfolio. And now on to the uncharted territory for today. So this is similar to the, what did I call this last time? The war chest that I mentioned in the last episode. We're calling this the liquidity layer. Liquidity layer, okay? It's a smarter way to withdraw. Now, again, I'm a big fan of having these very safe, very stable bucket of investments called your war chest in order to be drawing retirement from 3 to 5 years of income to be exact. But the liquidity layer is by having these safer investments accessible across the different account types, right? So maybe have some in your taxable buckets like we just talked about, have some in your pre-tax, and have some in your Roth. Just because in any given year, you know, if like let's say you can afford to take more income in one year because your income is going to be lower, then maybe we take it from the pre-tax accounts. Or if your income is going to be high one year, or you've already taken enough to kind of get you to the bottom of the next tax bracket, and you're like, oh, well, if I take any more, it's going to shoot me into higher Medicare premiums or something. Well, maybe then we pull from the Roth so it does not affect your taxes. So having this liquidity layer, a mix of stable, accessible assets across these different account types, it's going to support flexible withdrawals all throughout your retirement during these market downturns, and it's going to blend a little bit of behavioral finance, some tax awareness, and some real-world practicality, okay? Again, we want to avoid selling during market downturns. We want to maintain optionality for if we're looking at doing Roth conversions. Again, in your down income years, this is where you might want to be hammering your Roth conversions, or if you're going to be tax gain harvesting, okay, so that's the opposite of tax loss harvesting, is when you're selling things on purpose, okay, in the years that your income is lower. And then also looking at healthcare subsidies, right? So maybe you retire before you're Medicare eligible, and we need to decide how you're going to pay for your healthcare expenses for a number of years. That's where we can look about maybe trying to keep your income low so you can qualify for some of these government healthcare subsidies and get some credits back on your healthcare premiums. This liquidity layer is built into your portfolio to give you adaptability towards your life, okay? So it's not just looking at spreadsheets, not just looking at the returns and what makes sense. This is kind of what I was talking about earlier about advisors will build these investment portfolios that look awesome on paper and they project these types of returns. Oh, the Monte Carlo simulation looks great. You're not going to run out of money, blah, blah, blah. But that doesn't actually take into effect the reality that there is market downturns, okay? So it's not just a buffer, this liquidity layer, it is a bridge. It's going to help you cross the gap between these different market cycles and the different transitions in your life without causing panic or penalty. Now, key takeaway for today is tax efficiency matters, but not at the expense of flexibility, peace of mind, and that long-term growth that you are going to need in your portfolio, okay? A lot of people think that once they retire, they need to get completely out of the stock market. I disagree with that, okay? I think if you want to at least keep up with inflation, some of your portfolio needs to have some type of allocation into the equities markets. And your portfolio should be built for your entire life, not just your tax return. Remember that. Your portfolio should be built to last the rest of your life, not just making your tax return look good in any given year. So I want to encourage my listeners to review how your accounts are structured between the different taxable accounts, tax deferred, and the tax-free buckets. And if you are working with an advisor, ask them, how would your portfolio hold up during a market downturn, okay? If you're not retired yet, say, hey, if I was drawing income from my portfolio, what would be the best way to do this to ensure that I keep my long-term growth outlook? Do we have a liquidity layer built into the different accounts, right? And then last, consider whether your current strategy supports both tax efficiency and your emotional resilience. Okay, what does that mean? It just means if the market takes a downturn, are you going to panic that, well, there goes my life savings, there goes my nest egg, or are you confident in your approach to your investment portfolio that you can weather the storm, hopefully because you have a war chest of 3 to 5 years? Another plug there for that. And look, if you are someone who wants more information about this, okay, if you're close to retirement or you're in retirement and you feel like your current advisor, or if you don't work with them, if your current portfolio is not set up to these standards, we want to make sure your portfolio is built for real life, not just the spreadsheet. So let's talk, okay? So you can visit us here at SWBC. We're actually working on a landing page. Super stoked about that. My producer's in the back shaking her head because she's been working tirelessly on this. Shout out. Aww. Not shout out to you, just shout out to producer. Just kidding. So we're going to have a web page for you guys to go to get a little bit more information, and it'll be easier for you to schedule an appointment with one of the wealth advisors here at SWBC. So disclosure time. Nothing that I said was supposed to be taken as financial advice, tax advice, or legal advice. And everything that I talk about here is my opinion, not the opinions of SWBC or its executives. Just a reminder, we want you to subscribe to this podcast. If you don't, I'm going to continue to awkwardly stare into the camera every single episode. So please subscribe and tell your family about it and your friends, and just tell them how wonderful a podcast this is. Even if you get one little nugget of information out of this, I'm happy about it, right? So just share it with everybody, and I appreciate everybody taking their time to watch me on my soapbox. So see you next time. Bye. Well, if they're not, what are you waiting for? Can I do that or no?
Investing involves certain risks, including possible loss of principal. You should understand and carefully consider a strategy's objectives, risks, fees, and expenses, and other information before investing. The views expressed in this commentary are subject to change and are not intended to be a recommendation or investment advice. Such views do not take into account the individual financial circumstances or objectives of any other investor that receives them. This information should not be considered a solicitation nor a recommendation of an offer to provide any service in any jurisdiction where it would be unlawful to do so under the laws of that jurisdiction. Past performance is no guarantee of future results. Please consult with your individual tax professionals and/or attorney for additional information.